Well, happy Thanksgiving, everybody. I'm recording this Thanksgiving Eve. I've just worked out so I can get ready to go have my turkey dinner. But as promised, I'm going to do a video here on the solutions to practice exam number 2. If you haven't locked yourself in a room for an hour and a half and done the best you can without any job aids to do the exam first and come up with your own answers, I would suggest you turn this tape off and come back once you've prepared, if you've answered all the questions on the exam. And that way you'll reap the maximum benefit out of this. So please, 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 that was 3 pleases. Only view this video after you have first tried the practice exam on your own. So the practice exam, in terms of grading, you get 3 points for each multiple choice question. Multiple choice questions are very similar to the ones at the back of the chapter. And we've got 4 chapters, so I probably picked an even number. We got 20 questions, so there's probably 5 questions from each chapter. And the best way to prepare for the multiple choice questions is to do the multiple choice at the back of your chapter, and you can check your answers, I believe, online for those as well. Okay, so here goes. So let's take each multiple choice question first, and then we'll get into the short little problems. The short little problems, you've noticed, are very similar to the exercise, in-class exercises that we do. First question, which of the following would not be considered a merchandising company? A company that buys, a merchandiser is a company that buys and sells merchandise. So a retailer would do that, a wholesaler would do that, Amazon certainly does that, but American Airlines would not because it provides a service. 2, a buyer would record a payment within the discount period under a perpetual inventory system by crediting. With a perpetual inventory system, everything purchase, discount, freight, and all that sort of stuff actually becomes part of the inventory. So they record the payment with a purchase discount under a perpetual system. If you're going to take advantage of the discount, that's actually going to be a reduction of the inventory cost. It's different under a periodic system where you recognize purchases discount, but you don't recognize purchase discount under a perpetual system. Number 3. The entry to record the receipt of payment within the discount period on a sale of $2,500 with terms 2, 10, net 30 would include a credit too. Okay, so what would happen here is you would, it's a good idea when you do these multiple choice questions, think of what the entry is beforehand. So you would have received cash, and they would, if you paid within a discount period, so 210, whatever 2% of 2,500 is, I think that's $50. So you'd have a debit to cash, you would have a debit to sales discount, and you would have a credit to accounts receivable for C, $2,500. Number 4, which of the following accounts is not closed income summary in a perpetual inventory system? So you don't close out, the only one where you close out inventory is under the periodic system. There are special closing entries that you have to adjust the inventory based on the physical count. But inventory is not a closing entry under a perpetual system. All those other ones are. Number 5, Martin reported the following balances as of June 30th. And they said, okay, on the basis of those balances, what is the net sales? So the net sales would be the sales revenue minus the sales returns minus the sales discounts. So that gives me $15,500. 6, items waiting to be used in production. That would be for a manufacturer like Harley Davidson. So the materials that are waiting to go into production, those are called raw materials. So remember with Harley Davidson, I said you got all the steel, that would be raw materials. You got the bikes on the assembly line, that would be work in process. And you get all the bikes in the out in the parking lot being ready to ship out to dealers. That would be merchandise inventory. So stuff waiting to be put into production would be A, raw materials. 7, for companies that use a perpetual system, all the following are purposes for taking a physical inventory. So why would we take a physical inventory on a perpetual? Because in theory, on a perpetual, every increased inventory, every reduction inventory is recorded. So why would we count it? Well, we count it to check the accuracy of our records. Our records may not be correct. We want to figure out how much has been wasted, and we want to see how much employees may have stolen. If employees are stealing inventory on the way out the door, they don't stop off at accounting and tell the accountant each day how much that they stole. So the one that doesn't belong there says, which of the following are purposes of taking inventory, except the one that is the exception there would be determine the ownership of the goods. The ownership of the goods would depend upon the shipping terms, whether they were shipped free on board shipping point, at which point title transfers at shipping point, or free on board destination, at which point title changes at destination. Number 6, beginning inventory plus the cost of goods purchased. That gives us goods available for sale. Probably the most important formula in that chapter is beginning inventory plus purchases gives us goods available for sale. You subtract out of that ending inventory, that gives you cost of goods sold. Number 9, an error in the physical count of goods on hand at the end of the period resulted in an $18,000 overstatement of ending inventory. Well, if you overstate ending inventory, remember that's going to be subtracted from goods available for sale to get cost of goods sold. So you're looking for one of the choices there to be an understatement of cost of goods sold. So that's either got to be either C or A. And if you understate cost of goods sold, that's going to be subtracted as an expense. So if you understate cost of goods sold, then you overstate net income. So therefore, your answer is C as in cat. Number 10, inventory is reported on the financial statements at the lower of cost or market realizable value. So basically, this is the lower of cost or market rule says that if the market value of the inventory, what you could sell the inventory if you had to, is less than what you paid for it, then you have to, that's the amount you got to put on the financial statement. So the answer there is D. 11, from an internal control standpoint, the asset most susceptible to improper diversion and use is cash. That's why we spend all the time about all the internal controls over cash. Number 10, 2 individuals at a retail store work the same cash register. You evaluate this situation. Well, what's wrong with the internal control principles there? Well, if you got 2 people working the same cash register, that's a violation of the establishment of responsibility. Each person should be responsible for their own drawer. The best answer there is A. There's other things that are part of internal control, but they don't relate to this particular situation. Number 13, a daily count of cash receipts made by a department supervisor is an example of. So if this department supervisor goes and reviews the receipts, that's independent internal verification. Those other things are all good, but that particular example is independent internal verification. Number 14, journal entries are required by the depositor for all of the following except, okay? So when you look at the bank statement, if the bank collected money on your behalf, you're going to have to make a journal entry to record that cash that you haven't previously recorded. Bank service charge and a non-sufficient funds check, the bank would have taken money out of your account, so that's going to reduce cash. So those are going to require, all those are going to require journal entry by the depositor after the bank reconciliation. Bank error, that's something the bank has to adjust. We don't have to make an adjustment on our books. Number 15, which the following would not be reported on the balance sheet as a cash equivalent. Cash equivalents are cash, are things that are highly liquid, just like cash, that can be converted into cash within generally a 3-month period. So the one that would not be a cash equivalent there would be the 6-month treasury bill because it's too far out in time. Number 16, claims for which formal instruments of credit are issued as proof of debt. Well, that's the definition of a notes receivable as opposed to accounts receivable. Remember, a note receivable is a stronger legal claim than an accounts receivable. 17, writing off an uncollectible account under the allowance method. When you do the allowance method, when you write off an individual account, you debit allowance for doubtful accounts and you credit accounts receivable. So that's B, that's the answer there. And I recognize this company. Kerr Company has account balances at December 31st of accounts receivable and allowance for doubtful accounts of accounts receivable of $2,100,000, and you got a credit balance and allowance for doubtful accounts. And aging of accounts receivable indicates that $170,000 expected to become uncollectible. So when you make the adjusting entry to record the bad debts expense, you've got to bring the allowance for doubtful accounts up to $170,000 credit, but it's already got $20,000 in it. So it'd be a debit to bad debts expense, a credit to allowance for doubtful accounts. So the debit to bad debts expense would be $150,000. So it's already got $20,000 in the allowance. You got to bring it up to $170,000. That's $150,000 more. And when you recognize bad debts on the allowance method, you debit bad debts and you credit allowance for doubtful accounts. Number 19, the maturity value of a 60,000, 8% 60-day note. So if you take 60,000, you multiply by 0.08, and 60-day, that is 60-day note. That's basically 60 divided by 360. If you multiply that out, you get 60,800. You might get some rounding errors. You get rounding errors, pick the one that's closest. And then the last one here, financial statements of day manufacturing report net sales of 720, and accounts receivable of 70,000 and 90,000 beginning and end of the year, what is the average collection period? To get the average collection period, first thing you got to do is you got to get the accounts receivable turnover, which would be the net sales of 720 divided by the average accounts receivable. So you get 70,000 and 90,000. Half the average of those things would be 80,000. If you divide 720,000 by 80,000, you get a turnover of 9. And if you divide 365 by 9, that gives you roughly 41. So your best answer there is B. Right? So as I said, the best way to prepare for multiple choice questions is not only reflect on these, but do the multiple choice questions at the back of each chapter. And I believe you've got some extra practice that you could get also in terms of your Wiley Plus as well. Do as many multiple choice questions as you can. Okay. Now we've got 4 little problems here. Presented below is information for Oakley Company for the month of March. So you got to do 2 things. You got to prepare a multiple step income statement. So remember Wayne Gretzky scoring the goal. He had an image when he shot the puck of the puck going in the net. You would have have an image when you do a multiple step income statement of what it looks like. So you know you're going to start with net sales, which would be sales minus sales returns and allowances. You're going to subtract out cost of goods sold. That gives you gross profit. This is why it's called multiple steps. See all the steps here? Okay, there's your gross profit. You subtract out the operating expenses, and we don't have income taxes here. So the difference between the operating expenses and the gross profit gives you the net income of 27,700. And the gross profit percentage is just the gross profit of 254 divided by the net sales of 405. So you've got a 37.3% markup on every sale. That's the gross profit percentage. Number 10, Shell Hammer Company's inventory records show the following data. And a inventory at September 30th shows you get 200 units on hand. Calculate the value of the ending inventory and cost of goods sold using FIFO inventory costing and a periodic inventory system. So FIFO says first, there's a couple of different ways that you could do this. You could first get the total goods available and subtract out the ending inventory and get cost of goods sold. I'm going to do it directly here. I'm going to say I've got 200 units in ending inventory. So under FIFO, you would take the inventory be made up of your most recent cost, which would be 200 units at $3.70. The September 18th was your most recent cost. As far as the units that were sold, if we had total units available for sale was 900, and we sold 200, that means we had 200 left over. We must have sold 700. So where did those 700 come from? Well, they first were this 100 at this price, 450 at this price, and then 150 at this price. So there's your cost of goods sold. So you want to get ending inventory, and you want to get cost of goods sold. Another way you could have done this is multiply all these things out here, get the goods available, and then just subtract the ending inventory to get cost of goods sold. Number 23, this is a bank reconciliation. This is probably the most challenging one here. So what you need to do is you need to reconcile the bank's books to your books. They're never going to be the same. And notice there's a big difference here. Balance per the books is $3,664, and the balance per the bank statement is $10,900. So there's your starting point right at the top there. You start with balance per the books, and you do balance per the bank, and then you take each of these items here. Checks written in March, but still outstanding. Well, that would be a reduction per the bank statement. So you've got that as a reduction per the bank statement, and you've got checks written in February, but still outstanding. So you see them down here. You don't have to do these subtotals if you don't want to. So the main thing is that those are both subtractions to the cash available in the bank. Deposits of March 30th and March 31st have not been recorded by the bank, 5,200. So I've recorded them in my books. They haven't been recorded in the bank. So that's an addition per the bank balance. Non-sufficient check of the customer returned by the bank. That means the bank took $1,200 out of my account. So there's a reduction there, $1,200. Check 210 for 593 was correctly issued and paid by the bank, but incorrectly entered in the cash payments journal as 539. So you made a mistake. You recorded it at 539. It was really 593. So you've got to get the difference between those. And the difference between those was $54. So you've got to take another $54 reduction of your account, reduction of the balance per our records. And number 6, bank service charge of $50. I have to subtract that out of my account on my side, out of my balance for my books. A payment on account was incorrectly entered into the cash payments journal and posted to accounts receivable subsidiary ledger for $824, but it was correctly prepared. At $284, and the check cleared. So basically, what happened here is when I recorded the check for more than the check actually was. So if you take 284 and subtract that from 524, you'll see that it's a $540 error that I made. So I got to increase my account by 540. And then 8, the bank collected a note receivable from the company for $3,000 plus $100 worth of interest. So there, the bank collected that money on my behalf. Okay, so the way I did these is I did them in the order they appeared. What you also could have done is you could have just picked out those that required adjustments to the balance per the books, done that first, and then done adjustments to the balance per the bank, and you could have done that one, done it that way. Either way, that's you have to account for all these items. And notice the beginning balances were very different. And notice now these are this is the correct balance. I've reconciled these two. All the stuff on this side is going to require us to adjust our books. So we're going to have to increase our cash for this one and this one, and we're going to have to reduce our cash for these 3 items here. Okay, and then the last one, this one looks familiar. I think we actually did this one in class. Doesn't mean it's not a good problem. So you have to prepare adjusting entry to recognize the bad debts expense. So here's the accounts receivable, and whether they're current or whether they're past due. The higher up, further out you go in time, the larger the percentage that they're going to prove to be uncollectible. So if you multiply 120 times 1, 220 by 3, 110 by 6, 10 by 12, and 8,000 by 30%, you multiply those all out, you're going to get $6,000. But they've told us that there's a $700 credit balance and allowance for doubtful accounts. So the amount of the increase in the allowance is not 6,000. You got to increase it by the amount to bring it up to 6,000. So you already had 700 in there. So 6,000 minus 700 gives you 5,300. And then assume the same facts, but let's assume here that there was a $500 debit balance. So if there was already a debit balance in there and you want to bring it up to 6,000, then you've got to have an increase in the account sufficient to offset the $500 debit balance to bring it up to $6,000. So it's a debit to bad debts expense and a credit to allowance for doubtful. Okay, so I hope you found that useful. I'll do a separate little tape with some specific recommendations on how to do well on the exam. But in the meantime, please lick your wounds, take a look at the things that you got wrong, and go back into the text. If you still don't understand things you got wrong, post questions that you might have on the discussion board, and I promise to get back to those on a timely basis. Okay, happy Thanksgiving, everybody. Hope you found this exam review useful. Be well.